These videos and accompanying PDF package have been prepared by Patricia Malia. Personal use of these items is welcome. However, any use of these videos and package for commercial or monetary gain is not permitted without express consent from the author. Let's continue on this page looking at more of the underlying assumptions, principles, and characteristics of financial statements. Periodicity means that statements need to be prepared for a company within 1 year. Statements can be prepared for less than a year, for 1 month or 1 quarter, but never for over 1 year. This allows the readers to get somewhat timely information so that they can make decisions. Comparability requires the companies to make sure that their statements can be comparable to the previous year's and hopefully other companies' financial statements. We do this by showing our results as they are compared to last year's results, and also by not changing account names or accounting policies from year to year. The matching principle means that when you record revenue for a company, you must also record the expenses that were required to make this revenue. You cannot, for instance, record a sale in 1 year and the cost of that sale in another year. They need to be matched and put together in the same year. You can't have an income statement that just says sales of $10,000. You have to include the cost of sales too on the income statement for a total gross profit of $4,000. It does not work to have the sales recorded in the first year, the cost of sales in the second. Both need to be put on exactly the same income statement. So let's say that we received the cash for our sale in year 1, but we didn't pay for our inventory that we sold to our customer until year 2. We know we have to have the income statement at the same time in either year 1 or year 2, but when do we record it? Do we do it in year 1 or year 2? The revenue recognition principle is what answers that question for us. We do it when we do the work, not when either we receive the cash for the sale or when we pay for the inventory that we sold our customer. We're going to look at the revenue recognition principle a little closer later on. The full disclosure principle states that we need to disclose everything that we think may be relevant to our investors so that they can make the decision as to what they think is going on. Some of the things that we need to disclose will not be put into our financial statements. They may be something like a fire that has occurred after year end. If we know this while we're doing our financial statements, we would also know our investors would be very concerned about that, and therefore we would probably put this into the notes to our financial statements and let them know. Preparing our financial statements takes a lot of time and a lot of money to do. What happens is there comes a point where you have to say to yourself, we can't find anything else without it costing us too much money. To help us with trying to decide what's worth pursuing further is the materiality principle. Materiality means that anything that is below 5% of normal net income or normal profit is considered immaterial. If net income is about $100,000, $5,000 of expenses are immaterial. If you have revenue, for instance, of $5,000 or less that you don't know whether should be in year 1 or year 2, because this amount is considered immaterial, you can make either decision and it will not affect whether or not you are right or wrong, because the effects on the financial statements are negligible.